Have you ever wondered why people keep things like receipts or bank tellers after transactions? The other day I was emptying the contents of my bag and I noticed I had a lot of papers. Most of them were receipts for things paid for long ago. It took some time, but I was able to sort them into the ones I needed and the ones I could throw away. When businesses are involved in transactions, documents like receipts, bank tellers, checks, and others are used to show information about the transaction. These documents are called source documents and are given when transactions happen. There are different types of source documents and they have different uses. A receipt is given to show payment for goods or services. An invoice, on the other hand, is a source document that the seller sends to the buyer. It shows the name and address of the buyer and seller. An invoice also shows what was bought, the price and the quantity. Another source document is a check. A check tells the bank to pay a sum of money to the person whose name is on the check. A bank paying in slip is used to pay money into a bank account. It has more than one copy. When a seller mistakenly collects less money from a customer, he sends a debit note to correct it. And if he collects more money from the customer than he should, he sends a credit note. For example, if the customer buys goods of 25,200 and the seller makes a mistake and collects 22,500 instead, he uses a debit note to collect the balance. At the end of the month, the seller can send a statement of account to his customers to show all the transactions that took place during the month. Receipts, bank slips, checks, and other source documents might feel just like paper to you. But from this lesson, we can see that they all have their uses to the seller as well as the buyer. I hope you enjoyed this class. See you in my next class.